to shine. Don't know, but maybe there will be the time. Just show the moment, we make it better.
Well, I suppose we could. Well, good morning, ladies and gentlemen, and welcome to Investment Forum 2022, hosted by the Collaborative Exchange and in person after, I suppose, a few years of virtual hardship, shall we say. I was looking at a chart just yesterday comparing the relative market cap of ExxonMobil and Zoom. And pre-pandemic, this peaked with ExxonMobil being 3.5 times the size of Zoom. During the pandemic, Zoom, believe it or not, went to 1.5 times the size of ExxonMobil. And I'm happy to say, unless of course you're a Zoom shareholder, that ExxonMobil is now once again 3.5 times the size of Zoom. And hence here we are in person with you today. My name is Thato Mashigo, and it is my honor to host this panel today entitled Emerging Markets versus Developed Markets, Past, Present, and Future. So we have around 40 minutes scheduled for this panel. I'm not sure if we'll be able to go slightly over. I anticipate rather intense and robust and insightful discussions. To just give a bit of background on our topic, EM versus DM. I think it's been just over 20 years since Jim O'Neill penned his famous report announcing the arrival of BRICS and emerging markets onto the scene. And of course, the 2000s were the decade of infrastructure investment and the commodity cycle. However, the past 10 years, we saw quite a reversal of that, with developed markets outperforming emerging markets by around 7% annualized over the past decade. And of course, there are many factors that led to that relative outperformance. Of course, the world we inhabit today is quite different from the one that began over a decade ago in the aftermath of GFC and zero interest rate policies. Of course, we have a rising rate cycle and not so transitory inflation and its effect on equity risk premiums, as well as rising geopolitical tensions and, of course, the conflict happening in Ukraine and supply chain bottlenecks. So given that whole context and the world that we are in today, we have a group of esteemed panelists to unpack just what has happened in the past and what can we attribute to the relative outperformance of DM over the past decade, as well as where we are today currently in the world and where we might go over the next decade. So joining me on stage, we have Laura Cooper, who is Senior Macro Investment Strategist at BlackRock. We have Neil Padoa, Head of Global Developed Markets at Coronation. We have Katy Thorneycroft, Managing Director and Multi-Asset Fund Manager at JP Morgan. And we have Jacques Conradie, Chief Executive Officer at Peregrine Capital. Welcome to all of you on stage today.
Thank you.
So I'd like to split this discussion into two parts, beginning with the past and then moving on to the present and the future. So if we start with the past, and an event which was in somewhat of the recent past this decade, being the COVID pandemic. A lot of people said that COVID-19 was a litmus test almost for the economic resilience of various economies and various markets. Now, Laura, for you, this question, given the response of different countries to the COVID pandemic in terms of rapid fiscal and monetary responses, was that in any way empirical justification for the relative risk premium of EM over DM and the outperformance we saw over the past decade?
Great. Well, thank you so much for having me. I must admit that I don't know what's more terrifying, watching my Bloomberg terminals these days or actually being on stage for the first time since the pandemic. So this is a great opportunity. So thank you for having us today. today? This is a great question. I think looking back in the rearview mirror, investors in EM typically demand a higher risk premium owing to some idiosyncratic factors, right? They're more exposed to commodities, the dollar, politics. And when we saw in March of 2020, the commodity collapse, we saw the dollar being strongly bid. So there were these key headwinds. So yes, we did see the risk premium widen in terms of DM and EM. But again, it's really less about EM and what they did, but it's more a case of what developed markets were able to do and the capacity to actually have the degree of fiscal stimulus that came through in quite a timely fashion. We also had the healthcare infrastructure that clearly enabled the ability to deploy the vaccines. And then, of course, it was just the healthcare infrastructure around being able to test, the testing capabilities. Now, I think, though, it's really a case of you don't want to necessarily paint EM with this broad brush, because actually an exercise that we did when we were looking at portfolios back then was actually try to score, where are certain countries in terms of the vaccine deployment, the level of vaccines, and counter that with the cases of virus cases. And what we saw that some EMs were actually outperforming, notably when we looked at this on an FX basis at the time. So, for example, the Indian rupiah versus the Brazilian real were actually showing some characteristics that we saw in terms of the vaccine and virus data. I think going forward, though, at this point, it's really a case of not so much the pandemic and the aftermath of that, but more around the second-order effects, and certainly what we're seeing on the inflation dynamics. I think that's how we're looking at EM right now. We are in a period where we are seeing commodity price upside. Our view is we're still going to see that. So we want to be exposed to more of those commodity exporters. We do think that the countries that are better positioned in terms of capacity for reforms to spur growth are the ones where we want to have those positions, because we do still are in this environment of heightened uncertainty where foreign investors are going to have more scrutiny and due diligence in terms of allocating to EM.
Indeed, there's definitely enhanced due diligence in this risk-off environment. I suppose an open question just for the panel. How do you feel that investors are currently balancing risk on versus risk off, in the sense that from a relative perspective, we do have somewhat attractive valuations in some EM countries, whereas, of course, from a broader risk sentiment perspective, it is somewhat of a heightened, I suppose, risk-off sentiment environment. Just an open question if anyone would like to respond to that.
So look, I think if you look at a day like yesterday, it's probably one of the more unique days I've seen on markets, where you had the S&P close down 4%, but at the same time, bonds were down significantly. Gold was down 2.5%. So that's as much a risk-off day as I might have seen in my career. Like literally, normally bonds would be bid in this environment. So I do think we are seeing proper risk-off right now, and very few people have risk appetite to buy. And I think that it's probably right to be cautious. I mean, it's the first time in 40 years that the current generation of investors have to go through a potentially high inflation market. And I think the data shows that once inflation in DM gets above 5%, I don't think we've ever had a soft landing in terms of getting that back under control. So it's going to be a proper tightrope that the Fed has to manage. So I think you want to be cautious, but into weakness, prices have come down a lot, right? We are in bear market territory. So on the other hand, prices are cheap, and it probably makes sense to start taking some risk on into these down days.
Yeah, I mean, Thato, I'd take the other side of that, because when everyone is concerned and when there is a lot of caution and a lot of worry in the market, the flip side is that you get low prices. And we've already mentioned we're in a bear market. That hides massive dislocations in individual securities, where you see stocks that are down 50%, 70%, 80%. And time again, it's a point perhaps we'll come back to later on in the presentation, but markets can turn when you least likely expect it. And especially in times of uncertainty, the price that you pay relative to the value that you get, assessed over a long-term time period, is often the primary driver of future returns. And so I think there are actually very attractive opportunities emerging today.
Thato, I'd add on to this that I think you're right, Neil, in terms of maybe some of the security selection aspects, and I think this is a potentially a really good time for alpha and active management. I think the problem for me at the index level is those valuations, they're not quite in catalyst territory. So you add it all together, and at the index level, I think if you're just playing for beta here, futures perhaps and so on, valuations are certainly cheaper, but perhaps not quite where you need them to be there. But I absolutely take your point in terms of the opportunity for alpha generation from active management.
I think you're right. We're not particularly bullish on the market as a whole.
Yeah.
But the individual securities that you find, we tend to find, at the moment anyway, a lot of opportunity.
I suppose this is what makes the market interesting. Some will buy, some will sell. And so much debate around long duration assets as we enter this rising rate cycle. But we will definitely get back onto that topic of valuations a bit later. But Neil, if I turn to you, and if we consider the commodity cycle which we are in at the moment. And of course, there are significant supply chain bottlenecks, and that has led to rising commodity prices. And of course, there's debate around whether spot prices will hold, but we won't touch on that just yet. But going back to the EM versus DM, the EM index, of course, has significant weighting to commodity companies and commodity exporting countries. Now, of course, commodities tend to move in cycles, and some would argue that is it really likely for a commodity-heavy index to outperform and we're talking here about EM, to outperform an index in terms of DM, which is more weighted perhaps towards structural growth opportunities, if we want to call it that. And just your views on what that might mean or entail for long-term EM potential outperformance versus DM.
Okay. I think there are a few questions wrapped up in that. And maybe I'll touch on the latter question first, and that's to deal with the cyclicality of performance. And I think all performance is cyclical. It doesn't matter if you're looking at a single stock or a region, like you mentioned, emerging markets versus developed markets, or a portfolio manager, or sectors, all performance is cyclical. Now, sometimes those cycles are shallow and short, and sometimes they are long and deep. And in the case of emerging markets versus developed markets, you can really split the performance over the last 20 plus years, 20 or so years, in half. The first decade, where you saw sustained EM outperformance, and then the next decade from 2010 to 2020, where you saw sustained developed market outperformance. At Thato, as you know, we build our portfolios from the bottom up, and we don't tend to spend a lot of time looking at the top-down index. But just some context here, if you did do that exercise, you'd notice that the energy sector within the developed world is actually larger than the energy sector in the emerging world. And the material sector in the emerging markets is only 4% higher than the developed markets. So I'd actually, from my point of view, suggest that that 4% overweight or higher weight is really unlikely to drive a decade-long outperformance between emerging markets and developed markets. I think it comes back to what I mentioned earlier, price. And if you rewind to 2000, the developed world, in particular the US, was in the middle of the dot-com boom. So prices were extraordinarily high relative to the future earnings potential. And it took a long time for that market to really grow into those earnings. I think the S&P was flat over that decade. And that is the primary reason why emerging markets outperformed developed markets. If we flipped through to 2010, you had the inverse. So we were coming out of the GFC. So prices were extremely low. And as those earnings came through over the next decade, you saw sustained outperformance. So I think, if we look at the opportunity set today, I alluded to it earlier, we are seeing opportunities across the spectrum. In emerging markets, I would actually skew more towards the growthier, more innovative businesses. And in developed markets, we are seeing some commodity stocks which we think are very attractive. We like those because our assessment of the price relative to what they're worth is very attractive. And I think from our perspective anyway, that's where investors should really be focused rather than on the composition of the indices as a driver of future returns.
So very interesting points being raised by Neil, and I'll just open that to the rest of the panel. If I am hearing you correctly, perhaps by implication going forward, there's a greater opportunity set in the EM space relative to the DM space, and perhaps that the commodity aspect is not as big within EM as some of us may have preconceived notions of. Would anyone in the panel like to comment or interject on what Neil has raised?
I think those are really interesting points. And if you look at the UK or Canada, for instance, actually your energy and materials together is indeed higher in those markets than it would be across emerging markets in aggregate. And one thing that we've certainly noted when we've been looking back historically at some of our quant models, for instance, is we need to take note of that changing shape of emerging markets, the growth of tech that you've seen, that innovation coming through time. And so it is important to recognize the evolution of regions, of markets, of indices through time. And it's certainly relevant, but not all of the story, I think.
Indeed, indeed. There are multiple facets to the story and multiple chapters, should I say, that are still to be written. I think if we look at a similar theme, perhaps another sectoral theme, and this time, Katy, I'll come to you. Another, I don't know if it's a preconceived notion, but probably a firmly held belief that some investors would have regarding the tech sector and the past decade. Now, we know that obviously DM has outperformed, and the US has about a 65% weighting to the MSCI World. And within the US, there are various acronyms which have contributed to outperformance, whether you call it FANG or FAMGA, and I'm not sure what the next acronym will be, but whoever figures that out may make a bundle of money. But with regards to the US tech sector, how much of the outperformance in the DM space can we attribute to the growth of US tech in particular over the past decade?
Yeah, so it's a good question, and I definitely think it is part of the story. So you referenced that 7% outperformance that developed markets has enjoyed versus emerging markets over the last 10 years. So that is correct. If you were to look at that statistic for DM ex-US, you'd find it was more like a 3% outperformance. So the immediate thing is, well, we know that more than half of that outperformance is due to the US. And you get back to some of the themes that Neil has referenced here. When you look at the US overall, we also know that technology's probably delivered around 20% per annum over that period. It's been the earnings growth, it's been that re-rating that you've seen from valuations through that period of time. So US technology outperformance is definitely part of the story. But I think you have to look a little bit more closely at the fact that developed markets, excluding the US, has also outperformed. If we look back a little bit more deeply through time at emerging markets through this period, we know that the contributor to that total return, you've had great dividends, actually. The dividend yield in emerging markets is pretty attractive. You've had a de-rating, so valuations have dragged on that total return through time, but not excessively, but it has had an impact. But for us, I think the biggest relative difference is the earnings growth, where you've just enjoyed better earnings growth for developed markets through this period of time. Now, I think there's a couple of reasons for that. If you look at just the top line, the relative backdrop for the economic growth, you've had a narrowing of that spread between emerging markets and developed market growth through that period of time. But I think we all know that economic growth, GDP growth, doesn't necessarily translate perfectly cleanly into earnings growth, but you have had that impact, and I think it's important. And so then when you look at the earnings growth as well, I think emerging markets through this period has suffered from the headwinds of issuance and the dilution effect that causes down to the earnings per share line, and a lot of that has come from sort of IPOs in China and so on. So I definitely think it's important to recognize the stellar performance of the US driven by some of that re-rating, some of that earnings growth. But I do think we've had slightly lackluster earnings growth coming out of emerging markets over that last decade as well.
So I suppose in terms of that earnings growth from EM, would the panel have any further comments with regards to where that might be as we stand now, and are there any other factors which may have contributed to that lackluster growth relative to the re-rating and the earnings growth that we saw in DM?
Look, currencies have also been a key part of the EM underperformance, the fact that the currencies have consistently depreciated. And that's, I guess, another hidden element of the commodity story. These EM countries, even though the commodity shares might not be as big a part of their indices, it's a very big part of their exports. So typically in strong commodity cycles, you just have EM currencies being strong. I mean, we've seen it in South Africa in the last year or two. I think the rand has surprised many people, and it's very simply because we're running a trade surplus because of high coal prices, high platinum prices last year, and that looks set to continue. So I think that's one of the key things to look going forward is if commodities stay high, you might have a massive tailwind from these currencies together with the commodity prices that could flip the story of the last decade around.
Yeah, indeed. Currencies definitely do matter, and a lot of talk these days regarding currencies, especially the yuan and the US dollar, but I suppose we'll touch on that debate in a second from now. If I just go to you, Jacques, once more. So we've heard from Katy with regards to the multiple expansion that we saw in the US, and obviously driven largely by tech and earnings growth there. A lot of that earnings growth, despite being drawn into the tech sector, didn't find its way into new R&D and new innovation or capex, if you will, in the broader market, but instead it found its way into share buybacks and into special dividends and other returns to shareholders. Now, obviously, shareholders were very pleased with this, but some might argue that it has implications going forward for future growth. And I'd just like to ask your opinion on whether or not we saw the correct decisions from a capital budgeting perspective over the past decade, and whether or not this somewhat underinvestment in new capital spend is going to have more of an impact on the EM side or the DM side.
So look, as a principle, on average, we really like share buybacks when companies find higher returns buying back their own stock than they can investing into projects. So we think it should always be a trade-off. Look at what you can get buying back your own stock versus look at what you can get by investing in your business. And if the return on buybacks is higher, do that. Or if you have excess cash that you can't use in your business, do buybacks. I think specifically in the US, the reason for the large buybacks is to some extent these tech companies that purely almost do a tax arbitrage there. They've got big founders as big shareholders, and for the founders, it's highly tax inefficient to receive dividends, and it's very tax efficient to compound your wealth without realizing stock if the company does buyback. So businesses like, I think Google, Facebook and the like are just doing buybacks and they're just not doing any dividends. They're just purely focused on buybacks. So it's almost just an alternative return of capital, and we think it's largely equal whether you do buybacks or dividends. An interesting one to look at is also the commodity sector. And I guess your question is investing in your business good for the outlook? And if anything, historically, commodity companies have caused their own downfall by, in these commodity booms, all of them aggressively expand capacity, and then 2 years later, all these mines come on the line, and then there's too much supply and prices drop down. And interestingly, I think post the last cycle, 07, 08, where this investment happened, and then it led to the very low prices from probably 2012 to 2019, I think they learned their lesson. And we've seen the large oil companies, the likes of Glencore, they just did buybacks. Their own stock was cheap enough. The returns were higher than investing in new projects. And what have we got now? We've got a shortage of oil investment. We've got a shortage of new copper mines coming online. So if anything, that creates actually a very rosy picture for them. So doing the rational thing, investing in that, creates actually a very rosy outlook. And if anything, the things we see in the UK now where governments want to tax the super profits on the oil companies, that is so short-sighted, because what are you going to do? You're just going to encourage further buybacks. Who's going to expand capacity when you're just going to get taxed on your profits in the good times? So if anything, actions like that cause a shortage to continue. So we actually think, if anything, we like the buybacks that's happened, and it probably poises a lot of these companies to do quite well over the next few years.
I think it's an important point on the supply side of the commodity complex, because it was Charlie Munger who said, if you want to see how people behave, have a look at their incentives. That's a bad misquote, but the incentive structures in a lot of these energy businesses and commodity companies have radically changed. 10 years ago, they were incentivized to grow, so their capex was higher than their free cash generation. Today, they're incentivized to return cash to shareholders. And those CEOs want to get paid. So the next 3 to 5 years, that behavior seems like it's quite entrenched. And that's quite a significant change in how those businesses are going to be managed, with implications for capital going into the ground in the commodity sector. Just one point I disagree on. The reason why you've seen so much cash coming back to shareholders from the large tech companies is for a few factors. But number one, they are so profitable. Number two, they're extremely cash generative. And it is a far better use of capital to return it to shareholders via buybacks when your stock is undervalued than dividends. Dividends attract withholding tax, so you're getting 80 cents on the dollar for every dollar that's repaid to you. And if you're buying back your stock at 60 cents on the dollar, it's value accretive. And almost any incremental CapEx or M&A deal that they undertake is dilutive to returns as well. So we'd much rather see that capital come back. And then thirdly, the point around whether they're under-investing in their businesses, I think is just wrong. The capital in terms of sheer quantum and as a percent of sales is extremely high, but what that misses is the R&D that these companies are incurring, which is flowing through the expense statement, through the income statement. And that's many, many billions of dollars. So there's no indication from our side that certainly the mega cap tech names in the US are actually under-investing in their businesses.
Indeed, I think a lot of the deflation which we benefited from in the past few decades did come from the commodity companies, and perhaps the shareholders were not too pleased to be subsidizing global growth in that manner, and so we find ourselves in the situation we're in now. It's interesting on the windfall profits and windfall taxes that you did mention. It reminds me of a song from the 90s, if I were to paraphrase, "Don't go chasing windfalls." Interesting times that we do live in. And Neil, you are correct on that quote by Munger. I think he said, "Show me the incentive and I'll show you the behavior." And so we are definitely seeing the behavior from CEOs looking to their stock options and so on and so forth. But I think we can move into the second part of our discussion. So we've had a very good look at the past and some of the various factors that have led to EM versus DM relative outperformance in the noughties and in the 2010s, but now in the 2020s, the present and the future. And I think going into the year 2022, investors already had a number of concerns from relatively frothy valuations compared to historical multiples on the equity side, and very low long bond yields on the bond side, as well as being late in the economic cycle, rising inflation, although a few people were still in the transitory camp as we entered into this year. But nevertheless, geopolitical tensions were obviously rising, and of course we would be remiss if we didn't mention the Ukraine conflict, which of course has exacerbated supply chain shocks and inflationary effects. So this question for you, Laura, just having a look at the Ukraine conflict and its impact that it's had as secondary order effects on inflation and of course on global risk sentiment, what sort of long-term impacts do you think it will have, especially with new terms such as de-globalization being thrown about? And what should investors take away or be most concerned about with regards to this?
Yeah, that's a great question. I think certainly something that perhaps has been most surprising in a number of the client conversations I've had recently is just how frequently I'm being asked about deglobalization. Now, I would argue that the Russian invasion of Ukraine wasn't the catalyst for this. This has really been in the debate since probably around the global financial crisis, when we did start to see world trade volumes as a share of goods begin to level off after decades of a rise there. But I think, it's actually quite interesting that Christine Lagarde, in her recent ECB blog outlining a policy framework, actually mentioned deglobalization, not just deglobalization, she mentioned hyper-deglobalization, and the fact that the Russian invasion of Ukraine could potentially be a tipping point for that, because what we're seeing is that geopolitics are playing more of an active role in global supply chains. So in her argument was that we could actually see supply chains become less efficient on the back of what we're seeing in terms of the geopolitical tensions. So that's contributing to this inflationary regime shift that we're currently seeing play out. Now, I think from an investor lens going forward, we're really looking at this from two perspectives. One is looking at it from the risks, and I think we've seen some of this emerge when we see countries pursue nationalization, notably in closing some of their borders to exports on the back of these supply shortages. If we start to see that further play out, and then we start to see more of a tit-for-tat escalation, that's certainly a risk that we would say, look, deglobalization is probably more of a prominent trend that we need to have in conversations. But then kind of the other element of that is actually what we expect to happen is more of a diversification of supply chains. So we attribute this to something like a China plus one strategy, where manufacturers necessarily are still going to have that exposure, to a China manufacturing plant, but they're actually going to diversify it. And we've actually seen foreign direct investment in countries like Thailand, Malaysia, Vietnam on the rise on the back of this. So I think it's really going to be a case of diversifying supply chains rather than a full deglobalization trend accelerating, because supply chains are fairly well entrenched. It's quite costly, it's quite time intensive to have a complete rewiring of supply chains. Certainly interesting dynamics to watch out for.
Indeed, and I suppose if we talk of a China plus one strategy, there are very few countries which can be a plus one in and of themselves compared to Chinese manufacturing capacity, and perhaps we may find that it in fact is not so much deglobalization, because that one will be made up of a number of different countries, and perhaps it is in fact an increase in globalization. But I'd just like to open that to the panel, and what are your views with regards to where we might see supply chains and supply chain strategies going forward, and what does that mean for relative efficiency of the global economy?
Well, I think it means increased inflation. It's inherently less efficient, and countries are intentionally not taking advantage of their, to use an economic term, comparative advantages. And to bring it back to a stock specific, Taiwan Semiconductor, the largest manufacturer of semiconductors, the most efficient manufacturer of semiconductors in the world, is being strongly encouraged and incentivized by Western governments, for example, the US, to build fabrication equipment in the US. And the CEO has come out and said, we'll do it, but it's costing 2 or 3x. So it's inherently less efficient, and I think you can look through any number of examples, and it'll flow through the supply chain and builds inflationary pressures.
Indeed, a more inefficient world, and that may have ramifications for the share buybacks and dividends that Jacques mentioned earlier, but we'll just have to see how that does pan out. Neil, I suppose if we just go further on the Chinese angle, obviously there have been a lot of risks that investors are concerned about, and the zero COVID strategy which China has implemented obviously does extend some of the concerns of inflation, which you have touched on. If you just consider, I suppose, China as an investment destination, most global fund managers are, neutral or slightly underweight China, given some of the risks we've seen with regulation in the tech sector, and of course the extended lockdowns we've seen recently. But there are, of course, upside opportunities, potential for further economic reform going forward, as well as the impacts it may have on growth and their attempts to try and shift their growth model. How do you, weigh up those, I suppose, risks and potential opportunities when you consider the China opportunity?
I think from my perspective, and that's probably a sentiment broadly that the room would be in agreement with, China today as an investment destination for that incremental investment dollar, I don't think there's a debate that it is less attractive than, say, 3 years ago, all else being equal. Now, I'll come back to that, because all else is not equal. But China is less attractive today, and there's a number of reasons. I think the three primary concerns or risk factors at the top of my mind are, number one, political. So Xi Jinping has undoubtedly centralizing power around his own ideologies. And the valid question is whether this creates an environment where entrepreneurialism and free enterprise can thrive. I think it's important to remember that central to the Chinese Communist Party's success over the last 3 decades has been economic prosperity. And economic prosperity remains central to their future strategy. So we don't think they're out to impair the economy. They're out to make the to still grow the economy. As I said, economic prosperity is key, but make it more inclusive. The second worry or concern is on the macro, and again, it's fairly clear that China is entering a slowdown, partly because of zero COVID, partly because of property sector weakness, and the property sector is very important to the economy and the Chinese consumer. But China is not unique in terms of macro worries. I mean, we've discussed some of these already, but Europe is facing an inflationary pressure. Consumer incomes are being squeezed. Central banks, I think, have less tools in their toolkit to bring that inflation under control. The US is seeing potentially the housing sector starting to roll over, affordability is coming under pressure, and a weak housing sector has often been a precursor to a recession. So there are a number of macro concerns anywhere around the world. China is not unique. And the third worry is the regulatory risk. So for the last year and a half, it has felt like an onslaught of regulatory announcement after regulatory announcement. And that's really taken its toll on Chinese stocks, particularly in the tech sector. But I think the positive is that China is closer to the end than the beginning. And there's been a number of examples recently of how that tone is loosening. For example, we've had 2 sets of gaming approvals being released. There seems to be some progress between the Chinese and the US regulator in terms of opening their books for Chinese-listed US ADRs and letting the regulator comb over those financials. So there's a softening in the tone there, and I think that is China is far further along the path than many other economies. As I mentioned earlier, all else is not equal. Because of these worries and these concerns, the prices for Chinese assets have come down dramatically. And it comes back to what I said earlier. Price is what you pay, value is what you get. And it may have gone unnoticed, but since mid-March, China has actually outperformed the US in terms of the index level. And Chinese tech stocks have outperformed the Chinese market themselves. And we see this over and over again. We don't know if this is a trough, but often markets can turn when you least likely expect. Many investors have given up. They consider China to be uninvestable. We see tremendous opportunity, and it's the price you pay that is the most important, often, in determining your future returns.
Indeed, I suppose if the largest economy in the EM universe were uninvestable, then this debate becomes a moot point, almost. But if I could open that up to the rest of the panel, to what extent does economic prosperity correlate with common prosperity? Which is to say, is what we're seeing in China a cyclical slowdown, or is it somewhat more structural? And what are your views on the potential growth of that market going forward?
So I think that's really interesting. And when we've looked at sort of the development through time in terms of the Chinese government's approach here, I think there could potentially be an argument over the longer term that by including common prosperity and trying to get a more fair sharing of the growth, then you might get a better quality of earnings through time. You might strengthen the consumer, for instance. You're going to get a different shape to the economy and then potentially to the stock market. So I don't think that through time it's going to be the case that this is going to be a headwind. I think it actually could result in a better quality of earnings, potentially. But there's obviously a transition period. It is a slightly different growth model, and with any transition period, there will be some volatility along the way, I'm sure.
Yeah, I would echo that sentiment, just in the case of, if we look at investors are clearly underinvested in China from just a benchmark level. So, for example, we expect, China's growth accounts for about more than 20% of the global economy, but as global market cap, it's around 4 to 6%. So there is room for upside. So we see it as more of a structural, favorable trend over time, and probably some transition period.
I mean, just on my side, I'm slightly skeptical of their common prosperity phrasing. I mean, people forget that China is one country. They still actually have a ministry of propaganda, right? So they are masters at getting a message out there, but doing something else, right? So while they say that, we think as least as much important is just the power that these tech companies hold and the power they hold in the West. And I think Xi and the CCP saw that potentially there was a real power imbalance in the West where Twitter could take Donald Trump off their platform without the US president having, I mean, he certainly was wrong, but I guess it just showed the power imbalance. So I think part of it was putting the tech companies back in their place and showing everyone that Xi still runs the country and the CCP is all powerful. But as Neil said, maybe that might be coming to an end now. I think they've taken a proper hiding. The share prices are down, the earnings are down, so it looks in the short term that there might well be a reprieve where enough has happened.
Indeed. We are running short of time, so I would like to just ask one final question to the whole panel. Over the next decade, in your view, will EM outperform DM, or will we see continuance of DM outperformance, and why? Katy, perhaps we could start with you.
Sure. So over the next decade, we would probably sit on the side of emerging markets will be able to outperform again. And when we look at our long-term capital market assumptions, which is sort of a forward-looking 10 to 15-year expectation, we think that the growth backdrop, the earnings growth, the impact of valuations and the better valuations that we've got at the moment will allow there to be some tailwinds there on a relative basis. I will keep it short because there's so much more we could unpack there, but I will allow my colleagues to also answer that question.
Jacques?
We're also on the side of EM saying that it's 10 years are hard to forecast, and I'd say two key points. The fact that the commodity cycle is way underinvested due to a lack of capex over the last 5 years means you probably have an extended 5-year plus commodity bull run year, and new copper mine takes 5 to 10 years to build, not 6 or 12 months. So that's probably on the positive side on EM. And then these tech companies that's partly driven the DM outperformance, they are so big now, they're all getting into each other's space. Initially, there was an easy run where they could just take market share from the real world. Now they're all bumping into each other, so it's going to be a much harder 10 years, in our opinion, for tech.
I mean, I'm kind of going to be a little bit against consensus here because in our capital market assumptions, we still have developed market equities as probably one of our highest conviction outlooks. But I think certainly I would agree with the sentiment in the case of we are entering this very unprecedented period of monetary policy divergence. Certainly when we see the Fed tomorrow, I mean, are they going to hike by 75 basis points? It's quite an interesting time. I think developed market equities necessarily don't know how to adjust based on the dynamics we're going to see, whereas EM, clearly they're further along the tightening cycle. They do have the tailwinds mentioned, so maybe a bit sticky on the fence on this one. But.
Yeah. So Neil, the deciding vote is yours.
The deciding vote will go to emerging markets. We build our views up from the bottom, so don't have a view from the top down, but in aggregate, the upside we see is higher in emerging markets, and I think you have giant economies with huge populations that are still growing. And there's lots of opportunities.
Well, indeed. And I believe that brings us to the end of our session. It does indeed. See, we're being ushered off the stage. And so just to wrap up, thank you to my 4 esteemed panelists, Laura Cooper, Neil Padoa, Jacques Conradie, and Katy Thorneycroft. Thank you, ladies and gentlemen, for joining us. And I will hand over to our Master of Ceremonies.
Thanks, everyone. Very much indeed. And this idea of reglobalization that they were talking about is absolutely real. Pat Gelsinger, the CEO of Intel, was talking about how they are diversifying away from China, opening new factories in Poland, in Ireland, and in the United States. It is lunchtime, and 45-minute lunch, and then there are 3 breakaway sessions. You're familiar with those sessions. Enjoy those. And then back in the room, please. Very important to be back in the room after those sessions and the comfort break, because we go into the final 2 sessions of the day, and you need to be in the room if you want to be. First party to a potential iPad, and of course the grand prize of that fantastic trip to London in March 2023. Enjoy your lunch.